All right, so we're going to begin the quantitative concept section of the course. Now, quantitative concepts in general, include time value of money, discounted cash flow analysis, and some heavy statistics and probability theory, and some other concepts. But since this is a course for beginners, we only discuss some parts of the time value of money and descriptive statistics. Super important concepts. And if you want to know more, you can see a detailed version in the CFA course. And by the way, nowadays there are many, calculators and apps that can do the calculations for you. So you're not responsible for the calculations, but the presentation of formulas here are just to enhance your understanding of the concepts. All right, so let's begin with time value of money. All right, now as individuals, we often think about, saving money for future use or borrow for current consumption. Now, if you're saving money for future use, let's say you want to buy a certain item in the future. Now, you would like to know how much you need to save, every week or every month, and for how long to be able to afford that. And at what rate, what interest rate, which we will talk about soon. And, by the way, the calculation, it's not going to be as simple as you might think. Because, you might think that, all right, I want to buy something in, let's say, 5 years from now. And that item costs, I don't know, let's say $20,000. So if this is, today, 0, and this is 5 years from now. So you might think that, all right, if I save, let's say, $4,000 for 5 years, I'll be able to afford that. No. First of all, the item that you want to buy costs $20,000 today. It's not going to cost the same in 5 years, right? It's going to cost more because of, inflation. And also the money that you're saving, per year is going to reduce in value also because of inflation. So inflation is going to push one price up and the other one down. But if you're saving your money, let's say in a bank account that is giving you interest for your money, then, because of the power of compound interest, obviously also depending on how much interest you're getting, you might be able to get there a lot faster than you think. Anyway, we will talk about compound interest and the whole concept soon, but just wanted to let you know that it's not a simple math. And in case of borrowing, if you're borrowing, you would like to know what is the cost of that borrowing, that loan, or when you're evaluating an investment. Much of your work involves evaluating transactions with, present and future cash flows. In the case of an investment, if you're thinking of, let's say, buying a business. All right, so that business costs some capital, some, startup money. And then you probably estimate that that business is going to generate some cash flow, some income in the future. So your goal would be to find out whether the profits that is going to happen in the future will exceed the cost of that business today. And then, you can compare it to other investment options and figure out which one is a better deal. And, like I said, sometimes it's not going to be as straightforward as you think, because you could have different cash flows happening at different time periods. And the longer the periods are apart from each other, the harder it becomes to calculate. And overall, the reason the solution to all these problems becomes slightly complicated is that, the timing of cash flows affects the cash flow's value. Because money has a time value attached to it. Now, why does money have a time value? Money has time value because individuals value a given amount of money more highly the earlier it is received. And there are many reasons why that is. One obvious reason would be because of inflation, and other reasons that we will discuss soon. And we also know that money will be worthless in the future. Well, not worthless, it will worth less. Just wanted to clarify that. Anyway, quantitative concepts are fundamental to the investment industry. And for anyone working in the industry, understanding them is critical. Okay, great. Now we are going to talk about interest first. Then we are going to talk about simple and compound interest. And in case of compound interest, Einstein said compound interest is the eighth wonder of the world, or something like that. Anyway, it's a very important concept. And then we will move on to present value, future value, and discount rate. And then net present value, again, important concept when you want to compare different investment options and opportunities. And we're going to end the time value of money with annuity. Okay, great. Let's begin with interest. All right, so let's define interest first. So we know that someone who needs money borrows it from someone who doesn't need it right now and is willing to lend it. And if you can recall from the video series on the financial system, we call them the providers of capital, or simply savers. We also know that money today is better than money tomorrow. But let's find out why that is exactly and how we can relate that to interest. So let's go over a few scenarios. Scenario 1, by the way, this is the t equals 0, that means today, and t equals 1, that means 1 year from now. All right, so the scenario is that, let's say you lend me $100 today, and I give you $95 today. Would you take that deal? Well, of course not. I mean, I got $100, I should pay back $100, right? So that's pretty clear. Now, another scenario, again, T0 and T1. Today, let's go with this one. So you lend me $100 today, and I pay you back $100 a year from now. Would you take that deal? Well, if you're a good friend, you might, but otherwise you wouldn't think that's fair, do you? Now the last scenario, again, you lend me $100 today, and I pay you back $110 a year from now. Would you take that deal? Now that might be fair. So let's see why, one is fair and one is not. All right. So again, one thing we know for sure is that, money today is better than money tomorrow, because it gives you the choice of whether to spend or invest the money today and, avoid the risk of never getting it at all. And in terms of value, the money becomes less valuable, and the further in time we go, the less valuable that money becomes. So you got to be compensated. Because, for example, in this scenario, $100 a year from now is not equal to $100 today. And what makes it equal is the interest rate. So when we attach interest rate, we are essentially saying, in order to make these two cash flows that are happening at two different time periods equal, this is the amount we have to charge. Now the question is, what should that rate be? That interest rate, because we know that it could be sometimes 5%, sometimes 10%, sometimes more. So it varies depending on the situation. So let's see what an interest rate is and what the components of it are. Okay, so the first thing that we have to consider if we are lending money to someone is the opportunity cost of capital. Meaning, before you lend that money out, you have a choice of, spending it or investing it in something else. But once you lend it out, you do not have that choice anymore. If a better opportunity comes up, still you won't be able to use it because, that money is gone. And we call that the opportunity cost of capital. So the interest that you charge has to be at least equal to the opportunity cost of that capital. The opportunity that you forgo by lending your money to somebody else. By the way, we will see more of the opportunity cost in the economic section of the course. Now, the second component is, like I said, inflation. If you're living in a first world country, you're dealing with a 2 to 5% inflation rate. But, if you're living in a third world country, it is sometimes up to 20, 30%, sometimes even more. So that is the reduction in your purchasing power. So your money is being affected by the inflation rate. If your $100 could buy a certain items, 1 year later, you could buy less of those stuff. For example, if you're dealing with a 10% inflation rate, you have to pay on average 10% more for the same stuff a year later. And I say on average because, inflation sometimes affects some things more than other things. But again, on average, that's what you're dealing with. So, if you're willing to lend your money, inflation premium has to be in there. Now, the third component is maturity, meaning the duration of the loan. In other words, how long you're not going to be able to have access to that money. Is it 1 year? Is it 5 years? Is it 10 years? So generally, the longer the duration, the higher the interest should be. And the reason is because, a lot of unexpected events can occur during that time. So the longer you wait, the more risk you're taking, and you have to be compensated for that. We also have default premium that we have to consider, which means whether the person would be able to pay you back or not. How creditworthy is that person? And we can see examples of that by the way the banks treat someone that they know and is creditworthy compared to someone who is not. And the less creditworthy the person is, the higher the risk of default, and therefore the higher the interest rate. That's why, credit card companies charge a, higher rate because, they're taking a lot of risk. Okay, great. So when you hear the word interest rate, now you know it is made up of all these different factors, different premiums. Now, time value of money concerns equivalence relationship between cash flows occurring on different dates. That's why in order to make cash flows happening at different time frames equal, we need to use what is called interest rate. And you should know that interest rate is calculated on the principal. The principal is the money originally borrowed. So, overall, if we were to define interest properly, interest can be defined as payment for the use of borrowed money.